guys. Welcome to 2023, I guess. My first video for the year and for quite a while. Where to start? Well, I guess it's the fight between the Fed and the markets at the moment. We've got Jerome Powell talking tomorrow night at Jackson Hole. Ahead of the inflation numbers, which is what everybody's watching, 6.5. If they don't get anything under 7, the market will have a major spit. I guess anything over 7, and you get a bigger spit if the market's expecting 6.5. Death cross coming on the dollar index, but it's these I wanted to show you and talk about. Is that financial conditions are worsening in the US, i.e. they're heading into a recession, which is normally tracks the terminal rate, but the terminal Fed rate is going that direction. So as these guys say, Jerome's not going to be happy about that. And this one is even more interesting, is that you've got the stocks. This is the blue line. The stocks generally tracks the Fed balance sheet. The Fed balance sheet has been unwinding for some time, and stocks haven't been following it. So which one's going to catch up? Generally it is the stocks will catch up. As you can see here, the balance sheet increased and stocks slowly followed it. Balance sheet didn't or did increase there. Stocks overshot it, balance sheet started to drop, and then stocks caught up. So generally the stocks will catch up to the Fed balance sheet, not the other way around. So yeah, there's a lot of pain coming for stocks. Is what I would suggest as US heads into a recession, and interest rates will be going higher. The market's ignoring that, although overnight they sort of changed their position. So first it was Daly who came out and said getting inflation down to 2% won't happen this year, even with the 5% interest rate. And I wrote about that in my fundamentals blog yesterday. And then Bostic, another Fed member, suggests rates are going to be at 5.25%. and then hold until 2024. We're just going to have to hold our result, and it's going to take a long time. He's not a pivot guy. So US market peaked at the European closed, and then started to factor in the risk of what Jerome Powell's going to say tomorrow at Jackson Hole. Wall Street reverses, and we can see the price action in the Wall Street here. Or that's the S&P 500 I prefer to watch. Certainly reversed there. If we go to the hourly, you can see it more dramatically. Once the European closed, the stock market sold off as it started to prepare for that risk. But come and have a look at VIX, which is the fear indicator and the protection, and there's not much there. So there's no one's really starting to lock in protection for the downside. A bit of a movement here in the sort of closing hours of the US stock market, but when you look on the daily, it's at historical sort of normal levels where there's zero interest in protecting for the downside, and I think that's a mistake. I think VIX will start to price in that stock markets are going to have a hard year this year. Looking at US bond market, we're back at 3.57. That would suggest that the curve is the yield curve is kind of looking like that in the US, where the 3 months, 2 years, 5 years, 10 years sort of thing. But that's not the greatest looking yield curve, right? The yield curve should look like this, where you've got lower interest rates at the short end and longer interest rates as the economy grows. You don't want a contango market, which is looks like that, or actually a contango market looks like this, but certainly that doesn't seem great. Looking into commodities and how that's going to affect the Aussie dollar, gold seasonally this time of year does well from October through to February, and that's played out again this year. Wheat is not looking great. Iron ore okay, coke and coal pretty ordinary, natural gas ordinary, copper the surprise, which is doing well, but the Bloomberg Commodity Index also starting to weaken, and we've got oil sort of stuck under here as well. So not a great picture for the commodity markets. So I guess the highlight there is copper, which is a bellwether for global sort of the global economy and global growth. The demand for copper, which is one of the most used industrial metals, is generally a sign of global growth doing well. Looking into stocks, as I mentioned, I'm not a fan. You might have noticed that I'm actually short the Aussie just this morning over here. Not a fan of stocks at this time of year, particularly as we're heading into a recession with rate rises more than likely to come. The Fed may pause in February at their next meeting. I guess it'll all depend on the inflation number on Thursday. So Thursday is going to be a bit of a key figure. Clearly, if that's over 7%, then we'll get a rate rise in February. If it's around between 6.5 and 7, then there's probably a high probability that the Fed won't move rates. Just going into the currencies, and we'll have a quick look at the currencies. We'll start with the US dollar. It's well, the trade was yesterday with that bullish engulfing bar. I wouldn't trade now. Don't think there's too much more upside to this, particularly with Thursday coming along. So I prefer to trade out away from the US dollar this week because of the Fed. Because of the Jerome Powell tomorrow, and then the following day you've got the inflation numbers. I posted in Discord about the pound Aussie 4 hour. I've got that trade pending. That's actually in, and looking to sort of trade it across that range. Never been hugely successful at range trading, but I'm going to give it a go. Aussie yen, potential short here. You've got a bit of a resistance level here. RSI is at a good level to get short. You certainly want to be selling when RSI is above 50 rather than buying. You've got a bit of a high test bar tagging the 50 EMA. Quite likely there's a fib there as well somewhere. And 61.8 fib of that move. If we make the fib a bit bigger, it might be around the 38. Yeah, 38.2. So there's a reasonable opportunity there to look for a short. If this bar is a lower low, lower high, then on Wednesday maybe looking to short that. I don't hate the Aussie. I just don't have any reason to buy it. China's still struggling to come out. We've got more interest rate differential on the Aussie is weak, i.e. our interest rates are lower than the majors. So we're sitting down here. You've got pound, Kiwi, CAD, US all higher. So the interest rate differential is weak for us, where people would sell our currency, i.e. borrow money from Australia and go and invest in America, and you're picking up a 1.4% interest rate differential. That's even more stark when you look at, say, yen, and you borrow from the yen and you invest in the US, and you're getting a 4.6% interest rate differential. So that's going to be hurting the Aussie to a certain extent, but also China, yes, they've stopped the lockdowns, but they are still not running at 100%. a bit of a channel there if you or a trend line if you like trend lines to support the trade as well. So there's that potential there on the Aussie yen. Aussie Kiwi also done a bit of a cycle back to a resistance. Might be something in that as well if you like buying Kiwi. I don't particularly like trading Kiwi. I find it too difficult because it's too thin in terms of volume. Large orders can move it aggressively for apparently no reason. Coming into CAD, oil's been weaker, so you'd expect the CAD to struggle, and on the back of that I've seen this, we're in an uptrend, we're getting higher highs and higher lows. Done a nice cycle here, and I'm looking for another cycle out here on the pound CAD. Also you've got a bit of it is class A momentum divergence, where you've got lower lows in price but you've got higher lows in the momentum indicator. That's also a bit of a bullish signal. So there's the pound CAD. The pound Aussie one I've already spoken about. Pound yen looks, and these two look really messy, and I've got no interest. It'd be hard to make a trade work on those pairs. Swiss, I don't like trading Swiss because of Thomas Jordan. Thomas Jordan is the head of the SNB. I believe he still is. Royally screwed everybody in 2015 by removing the peg, and continues to manipulate the currency by intervening and selling the currency outright to try and control the value of the Swiss. So I don't particularly like trading it unless I'm going to sell the Swiss and go with the central bank. Euro, again, the trade was yesterday. I don't know how much more upside this is going to have. I think you can find better opportunities, maybe the Euro CAD, but there's not a lot there for me to take advantage of. Pound, yeah, I think I've gone through pretty much most of the pound pairs anyway. And yen, dollar yen in this nice little channel, might be something there for you. Aussie yen mentioned, and that's about it as far as my eye can see. And cryptos, well, struggling. Ethereum, I don't trade Ethereum anyway. Yeah, not a huge fan of trading them. I'll leave that to other people. That's about it for the day, guys. I think that I've spoken long enough, 13 minutes, but I shall see you tomorrow.